Well, hello everyone. This is a half hour of my quarter that I look forward to each and every time. We get to be here with Larry Cantor, chief economist at Atlas Merchant Capital and founder and co-CEO of Atlas Merchant Capital, Bob Diamond. These two guys are people I look up to, people I seek out for their counsel all the time, and to get to share them with you on this quarterly basis is really a treat for me. And it's a treat for all of us because you two have been amazingly prescient over the last couple of years that we've been doing this together. Larry, if we had published on a quarterly basis your insights, your recommendations, your best estimates as to what we were going to do, I think there'd be a special prize. And they're handing out Nobels in a pretty regular fashion. And I'd like to personally nominate you because you've helped us so much in these last couple of years with these briefings and updates to understand how the world is shifting and changing and what the economic consequences of all that changes are. In a brief conversation we had the other day, you summed it up by saying that stocks are simply adjusting to the higher bond yields. I know it's a lot more complicated than that, but without waiting another minute, I'd love to hear your thoughts on where we are today. Mr. Great Seer and Wise Guy, Larry Cantor.
Yeah, you always get nervous when somebody sets you up like that. Records, but
Well,
I appreciate it. Thanks, Jim. So anyway, I am going to talk a little bit about markets just because, that's been the big news, especially the bond yield move. So let me start just by saying the biggest economic news over the past few months since I did this the last time is that inflation slowed sharply, even as the U.S. economy accelerated. If you step back a little further and say, well, what's the story of the year? It's probably the resilience of the economy in the face of what's been historic tightening in monetary policy. Recession forecasts have been abandoned for this year. And most projections for the third quarter, we just finished the third quarter, but it'll be a month before they give you the first estimate, now expect growth of over 3%. That would be the fastest growth we've seen in almost 2 years. Meanwhile, even with the low inflation figures that were reported this summer, the Fed has made it clear it's not going to cut rates anytime soon. So, as you said, none of this has really been a surprise to us, but financial markets have made significant adjustments to the reality of higher rates for longer. Fed rate cuts are no longer priced in for this year, and bond yields, as everybody knows, have risen significantly. And the sharp rise in bond yields has caused stock markets to drop over the past couple of months. So one question is, are higher rates just a cyclical blip, or are they sustainable? I'd argue that we're in a new environment as far as interest rates and Fed policy are concerned. If you look back following the financial crisis in 2008, all the way through the first years of the virus, interest rates have been unusually low. Even in that, the Fed funds rate since the financial crisis and going into the first couple of years of the virus has averaged less than 1%. And that compares with an average of over 4% during the 15 years or so before the financial crisis. I think I've said this before, but policy rates under 1%, that's not a sign of economic or economic health. And if you look at 10-year U.S. Treasury bond yields, they've averaged around 2.5% since the financial crisis, compared with around 5% before that. So the fact is that 10-year U.S. Treasury yields between 4 and 5% are consistent with the environment that we're now in. I think the first thing I'd list, just to go over why we're here, is larger fiscal deficits are generating increased Treasury issuance. And I actually think, in terms of the jump we've seen over the last sort of month and a half, which has been about 75 basis points. That's probably the major reason. The budget deficit is rising sharply after dropping sharply from 2020, where we had almost 15% deficits to GDP, to fiscal 2022, where it was like 5.5. We're going to get numbers. The fiscal year just ended last week, September 30th. We'll get numbers, but we're talking about a budget deficit that could be somewhere 6.5, 7% of GDP. And I think this turmoil that's going on in the House of Representatives right now is not giving anybody a lot of hope that Congress is going to take action to reverse this trend anytime soon. So that's, I think, a big factor in what's happened here. The resilience of the economy has finally convinced markets that the Fed policy rates are going to be higher for longer. And finally, in terms of the third big factor for rising bond yields, the Fed has shifted from quantitative easing to quantitative tightening. They're calling it QE to QT. So instead of buying $80 billion a month of US Treasuries and 40 billion of mortgage-backed securities, it's now allowing 60 billion of US Treasuries and 35 billion of mortgage-backed securities to mature without replacement. So that's a big shift also in terms of why bond yields are up. So question as always is, where do we go from here? So let me start with the economy. So while we all know we haven't repealed the business cycle and a recession is going to happen at some point, it's hard to see one happening anytime soon, barring, of course, some unforeseeable major event. The major cyclical sectors, housing and manufacturing, already got clobbered last year and are bottoming, even though this recent jump in mortgage rates has caused a decline over the last month or so in housing. Meanwhile, the labor market keeps creating jobs. Consumers continue to spend. And just let me say a couple of words about consumers. You know, everybody's surprised they keep going. First of all, if you look at household debt service, okay, so this is debt payments as a percent of disposable income, they're at reasonable levels, partly because people locked in a lot of low-term financing. And they're well below what you usually see at cyclical peaks. Usually debt service is very high before things come down. It's not particularly high.
Larry, have we run off the excess savings you talked about the last time we gathered?
Jim, boy, you're very alert because you probably know me. I was just about to say, it's interesting because, as you know, Jim, I've said this before, all that COVID stimulus, we ended up with over $2 trillion in excess savings. In other words, above the trend that was existing before. And we all thought, given all the GDP numbers and all that, we were down to under $500 billion, something like 400 billion. And then they just revised all the GDP figures with much more information. It now looks that they have 1.2 trillion in excess savings. So there's a lot more left there than we thought before. They just revised late last week all the GDP figures, and all the economists are now going back to the drawing board and saying, wow, the consumer looks a lot stronger. So it's this combination of, you know, their household balance sheets look great, and then there was all this COVID stimulus. You know, and part of it also was, as you know, the first year or two of COVID, people stopped traveling, they stopped going out to restaurants. It built up a lot of savings. Now, having said all that this is why, you know, probably not going to see a recession anytime soon. The acceleration in the U.S. economy, which was, I think, one of my main points 3 months ago, that we've seen this year, again, third quarter looks really is going to be very strong. It'll come out at the end of this month. There are several headwinds that I think are going to slow things down as we head into the end of the year. One is student loan repayments. So they resumed October 1st. And just to give you a sense of how big this is, about 40 million people have student loans. The total debt outstanding is $1.7 trillion. Average monthly payment is around $350. You might have read just the other day, the Supreme Court struck down a plan by the administration to forgive a lot of this. Um, President Biden's doing some things. He just signed a bill to forgive, I think it was 9 billion, but we're talking about 1 point. That's a drop for 125,000 borrowers. Again, we have 40 million people that have this. So that started October 1st. That's going to take something out. I was going to talk about higher energy prices, and I think that is a factor. You probably know, at the end of June, crude was about $70. Up until a couple of days ago, it was 90, and retail gasoline prices have gone up. Just the last 2 days, it's dropped. I just looked this morning; it's 83 and a half. So that may not be such a big factor, but as you know, Americans pump more gas than any country in the world, and that's a big factor, and that'll keep a little bit of a lid on consumer spending. We've got a lot of strikes now. As I mentioned before, things have changed in the labor market in terms of power, workers relative to employers. The UAW's on strike, we know. That's widening. Worker strikes in general are increasing. That's not a big thing in and of itself, but it's one of those factors. The dollar's gone up. What that does is it curtails exports, right? Our stuff gets more expensive, which will limit growth, and it increases imports, which doesn't add to our GDP. And finally, these market moves, higher bond yields, lower stock prices, that's the kind of thing that usually hampers sentiment and spending. If you look at 30-year mortgages, they've now gone over 7.5%. So, this will also, so all those factors, as we go into year end, are going to hamper things. By the way, I haven't mentioned the government shutdown. As we all know, Congress just
what government shutdown?
Yeah, right. Just kicked it. Well, there's none right now, but they just moved it out 45 days. So November 17th, we've got another deadline. And at this point,
we don't have a speaker.
Right, exactly. The House is in disarray, unable to come up with agreement on spending bills to keep the government running. But I will say this, and we've talked about this. They hit the U.S. economy pretty hard, but spending and output recover once the government resumes activities and people get their back pay. So it ends up having little net effect on the economy, although these things have often lasted for weeks. This disarray is definitely having an effect, I think, on the bond market because, as I say, the deficit's going up a lot. And, the idea we're going to get any tax increases or spending cuts anytime soon look pretty far-fetched at the moment. So where are our forecasts for GDP? Right now, they're in the 1 to 2% range. I think that's reasonable. When we get Q3, we just started Q4. When we get Q3, which will be at the end of the month, I would not be surprised not only to see a 3 handle. Some people are even forecasting 4%. So we had that acceleration that I was talking about 3 months ago, which nobody believed in at the time, actually happened. Now, after that, what happens next year? I mean, my best guess at this point is we go back into like a trend-like pace, like 2%.
On the GDP growth?
On GDP, yeah, that nothing terribly exciting, but I think, but again, hard to see a recession unless something happens. And I'm talking about the first half of the year. So I'm going to get to that. Let's go to inflation. I'll tell you, Jim, you're right on point because that was my next topic. So again, as we talked about a few months ago, I said we're going to see really good summer numbers. We did. So if you look at the core PCE, and I don't want to, there's PCE and CPI. These are just different inflation measures. The Fed prefers the PCE, personal consumption expenditure deflator. So the last 3 months these are monthly increases, 0.2, 0.2, and 0.1 per month. That's June, July, and August. If you annualize that, it's 2%. That's the Fed's target. It's pretty impressive. The core CPI came in also low, not as low. It annualized to like 2.8%. These were really good numbers in the summer. Now, if you look at the year-on-year numbers, rather than what happened over the last 3 months, we're still way above target. So it's 3.9% for the core PCE, a little under 4%, 4.3 for the core CPI. So a little, and the Fed's target's 2%. More importantly, a portion of the weak summer were due to sort of temporary one-off effects. One is COVID messed up the seasonal factors, and that helped. The other thing you remember, used car prices finally came back down to earth. That won't be repeated. That said, the decline in housing costs, which is a big component of both the overall and core inflation, that has not yet been fully reflected in the inflation data. So there's further room for improvement down the line. On the other hand, just look at the next few months, healthcare costs, which have really helped slow things down, that contributed to the recent slowing. That's about to reverse. They calculate it in a very funky way. If anybody has any questions, I can talk a little bit about it. That's set to add a little upward pressure on inflation. So if I add all this up, I'd expect core inflation figures to average sort of 0.2 to 0.3 per month, which translates into an annual rate of like 2.5 to 3.5. So
Larry,
the question
you
is,
told
what
us a
is
few times in the past that when we look at inflation, we shouldn't be so concerned about the 2% target. That you've told us what's more important is a stable, predictable rate.
Right.
And it seems to be that your expectation now is a 2.5 to 3% rate for next year is manageable. And it sounds to me like you're saying 2% GDP forecast, 2.5 to 3% inflation, labor market staying tight, trying to digest some angst that's going through it. You're pretty comfortable with next year. Housing's going to remain an issue. You talked about the headwinds. Healthcare is going to contribute more to the cost of inflation. Automobiles, not likely. So everything seems okay for calendar 24 in your mind. But then you scared the heck out of us with the big macro issues down the road. And Bob, you in particular have a point of view about politically, behaviorally, the US leaders, and frankly, all of the leaders around the world have learned that there's no real consequence to running these deficits in the short term. But Larry, Bob, is there a consequence in the long term?
No question about it. I don't know, Bob, but they are going to have to do something. I mean, and this, I don't want to get into politics because I'll tell you this, there's lots of blame on both sides of this. You remember the Trump tax cut occurred. If you look at when you took economics, what economists say is you're supposed to stimulate when there's recession and then go back when things are good. That's how you're supposed to do it. Well, we got a big tax cut back in 2017 when things were going great. Then we had a recession and had the most stimulus we've ever seen, $5 trillion, which, by the way, had really cushioned us. That was a big factor cushioning us, right? But you have to pay the piper at some point, and tax. So if you look at why is this deficit going up, the majority is actually very low tax revenue. I mean, again, we had a big tax cut when things were going well. And then a lot of spending on, Social Security payments went up. Medicare payments have gone up. You've got a
Ukrainian war.
Bigger, the Ukrainian war, but the debt, the Treasury, it's an interesting thing. Every year, I don't know, the Fed usually makes a profit every year, right? It's pretty nice when you can create money and buy bonds. And that profit goes to the Treasury every year. Guess what? For the first time, I can't even remember, they're having a loss now. Why? Because you remember they bought all these bonds.
The same, they're having the SVB
as
problem.
The banks, exactly. They bought all these bonds. They had to, to do QE. And now what's happened to the bond yields? So they're actually producing losses. So that's usually that helps shrink the deficit. It's going the other way this time. So, these are a lot of things, and they're going to have to address this at some point. But let's get to the Fed and then I'll just get to my bottom line, and then I'm just about finished here. So what does all this mean for the Fed? And I'd say the first thing, the Fed has not been this encouraged since COVID first showed up. I mean, don't get me wrong, it's still alert to whether have they done too much or too little. But if you told Powell and his colleagues back in, early last year, when they realized they were way behind the curve, inflation was raging, they knew they'd have to hike rates by a huge amount and quickly, that we'd end up where we are now, they'd have been thrilled. I mean, think about it. We've gotten inflation down from like 7 to 9% to 3 to 4% without triggering a recession and with an unemployment rate still under 4%. I mean, they wouldn't have believed that. And then finally, just recently, financial market conditions have finally tightened to support the Fed's efforts to slow things down. We now have bond yields well above 4%. Stock prices have gone down. The dollar's moved up, which should help moderate inflation and keep the brakes on the economy. So all this, just to sum it all up, and then I'll stop here, that the Fed's very likely to remain on hold for the rest of this year. I think there's a very small chance of another quarter point rate hike, but with what's gone on with bond yields in the stock market lately, I'd be very doubtful. I think the economy will come off its robust third quarter pace, as I said, but I just can't. It's hard to see a recession anytime soon, as Jim says. The sharp drop in inflation this summer, you're not going to keep getting that kind of drop, but it should settle at a pretty reasonable pace, like 3% going forward. And finally, with markets having adjusted to a resilient economy and a monetary policy restrictive enough to maintain low inflation, I think probably the big moves in the markets are probably behind us for a little while. So that's it, Jim. But getting back to your point on inflation, 3%, that stability is the most important. The Fed still has this problem where they have this 2% target, and they're very nervous about their credibility. So we'll see what happens. But this isn't an issue for, many months down the road.
Bob, I see you put your worry beads down, so that's a good sign. But
right here,
Bob, a little bit on that political issue. It's a global joke now that there is no short-term political consequence for spending. And as Larry pointed out, during the Trump years, which were boom years, we reduced income and on a federal level, which inflamed things even more. So has the politic changed globally in the Western world?
Well, the numbers are stunning, Jimmy. And just to put them in numbers of what Larry said, when Trump took office, the outstanding debt was about just over 20 trillion, a huge, huge number. Since then, during the Trump administration and the Biden administration, frankly, it's been a Goldilocks economy and markets, and it's gone up to 33 trillion. What's going to happen when and if we have a turn down in the economy? And so I think this is a huge issue for the global economy. The U.S. economy will not be able to be counted on in tough times ahead. And I think, on the other hand, the rest of the world is looking at the U.S. and saying, how did the Fed engineer this? How is the U.S. economy kind of this strong coming out of raging 9% inflation just, 18 months ago? So on the one hand, the world looked at this incredible recovery, and it has been an incredible recovery, but the price we've paid is not being accounted for correctly yet, which is that the deficit is up to 33 trillion, and the interest on that, if you market to market, is 5.5 or 6%, not zero. A huge difference. And so where will we be able to cut spending? It's not clear to me. With Social Security and defense pretty much locked in, and Medicaid locked in, and the interest rate payable locked in, there's not much room. And so, Jimmy, I have worries going forward.
Yeah, so longer term, short term, next year or so, you and Larry see pretty calm seas. That's good. Longer term, we have these macro issues, which are someday going to confront us. But I have to ask you both. I spent last week out in LA, so I Ubered around a lot, and it was a great experience all the time. Let's say I had a dozen, maybe 15 different Uber drivers, and they were all nice. They were all competent. They all had clean automobiles. They're all good drivers. And not one of them was born in the US. And I heard from them how much the gas prices are impacting their lives, food prices are crushing them, shelter costs, housing costs. It was top of mind for each and every one of those. And as we drove past a gas station on Lincoln Boulevard down at the beaches, and you passed a gas station with a price per gallon sign of $7 plus, that's a billboard in the face of every working person in this country that things are toughest on them. Do we live in two worlds now? We saw in the Wall Street Journal the other day the story about college-age people, college graduates are faring very differently than the non-college educated workforce. How can this exist? Larry, Bob, you're telling us things look pretty solid for the next, let's call it 15 months. But I'm telling you, the other side of the world, the other part of our economy is hurting.
Yeah, this is a great point, Jim. And here's the thing. In terms of managing the economy, we all look at inflation, which is the change in the price level, and getting, as Bob just said, inflation down from 9 to 3 or whatever is a tremendous achievement, especially given that we didn't crush the economy. There was no recession. But people, what do people care about? What price am I paying? And so, again, in terms of managing overall economy, that's what's important. But in terms of how people feel, they just care about what price. So, in other words, prices went up 9%. Now they're only going up 3%. But that's
it's on top 12%. Of it.
It's exactly. So it's a political problem for the administration because, again, from the policymaker world and from our world and finance and everything else, what we care about is low and stable inflation, because we've seen what happened in the 70s. Once it gets to 10%, I mean, it gets out of control. And then you got this wage price spiral. And the Fed's done a great job getting it down. But people feel pretty bad because a couple of years ago, they were paying whatever it was for gasoline. Now they're paying $2 a gallon more, or for eggs, or for whatever.
Butter.
So, yeah, butter. So it's a very good point. And it shows you sort of the difference between, this is why, by the way, economists usually have very little voice in administration, because the political effects are different from what economists, recommend. And so, anyway,
Bob,
the two world question.
Well, I think, what this means to me, Jimmy, is that what we saw in banking with SVB and First Republic, what was it, 6 or 7 months ago, is something that we're going to see more of outside of banking in corporate America, but also in corporate UK and corporate Europe. It's even tougher in Europe, where they're revising inflation up and economic growth down. At least here in the US, we've been revising inflation numbers down, better, and economic numbers up, better. So we have a real challenge. And I think as we look to invest in businesses, we're really, really paying attention to the capital structure, the need for funding, and that's going to be the big thing. So for us—
And Europe is much more affected by energy.
By energy, by Ukraine,
by energy costs.
By the slowdown in China, by almost all the factors that we worry about, they have more of an impact on Europe. And yet Europe has less flexibility around fiscal measures. So I think it's hard to see a robust European economy over the next couple of years. I think they'll continue to be challenged by higher inflation. And the challenge there, Jimmy, is also it's very different country to country.
Yes.
So they have to manage kind of a mix of high inflation countries, kind of more and low inflation countries with the same monetary policy and fiscal policy.
But tourism has never been higher in Europe, so much so that they're starting to tax tourists to try and control the crowds. It's a mixed up world we live in.
Do you have any friends that didn't travel to Europe this summer?
I don't have any friends, Bob. Come on. Well, guys, you did it again. You help us so much with your insights and forecasts. There's so much to cover in a half hour, but lo and behold, you did it again. I think we have good vision in our forecast of where you see things over the next 3 and 15 months. And we thank you very much for your insights, your time, and your candor. Thank you, guys.
Jimmy, thanks for all you're doing at Worth. We appreciate it.
Thank you.